on a Bitcoin standard, like, or if we had a rational switch to free market money, how much do you think something like the S&P would be gaining? And like, because I'm thinking maybe it will gain less because of competition, maybe it'll gain more because of productivity. So what do you think in terms of Bitcoin, the S&P would be going up annually?
Yeah, that's a great question. And I guess I'll start by saying I don't really have a decisive answer for this question. I don't really think I have a clear idea about how it plays out. But I do have several potential answers. And I'll just begin by saying that when you consider questions like this, it's difficult to think in terms of um, how things are going to play out because all of these things are, as Mises or Hayek would put it, they're the products of human action. And so it isn't. We're not trying to predict the movement of a ball that you kick. So if you kick a ball, the same ball with the same kick every single time, the same amount of force exerted onto an object, it'll produce the same exact reaction every single time, and you can recreate it in a lab because it's all dead matter that's just reacting to your to the power that you exert upon it. But human beings are not like that. If you kick a human being, you'll get a different reaction probably every single time. They'll react in different ways. Human beings are much more complex. And because they have their own mind, their own brain, which understands things and reacts to it, it's very, very difficult to understand how they'll react. And, we're not talking about a reaction in a laboratory setting. So it's not like we could just put people in a lab and study how they're going to act and then extrapolate based on that. Because the reality is, we're talking about a complex system in which a lot of people are going to act and react to one another's actions, and then their actions are going to create a reality which we cannot even foresee. So it's really, really difficult to foresee things. I guess a good example would be, imagine if you were trying to predict what the last 50 years would have looked like 50 years ago. So if you were alive in 1975, I mean, think about the most important things going on in the world today. They are things that you wouldn't have even imagined in 1975. You couldn't have imagined that, say, the seven biggest companies in the world are Facebook, something called a Facebook, where people post pictures of themselves and then connect with each other and talk to each other and get into fights about politics with one another. If I tried to tell you that in 1975 we're going to connect billions of devices all over the world and everybody's going to put their face on a page and start fighting about politics and posting cat memes, you're not going to really. I mean, it's not like you can't even predict that. You can't even imagine that. What does that even mean in the context of 1975? And Uber, Google, just the idea of a search engine being a big deal in 1975. I mean, if I told you about Google in 1975, you would have imagined, okay, seems like a nice replacement for a little library index card system. No way that's going to be one of the biggest companies in the world, right? So it's really difficult to predict these very complex market phenomena as they evolve over time. But that's not going to stop me from trying. So let's do it. So I think the if we do have a system, if we do have a world in which we just have Bitcoin as the only money, in that kind of world, then everybody who just wants to accumulate wealth into the future can just hold money. And so if you want to save, you earn money and then you keep that money in the money that you earned and you don't spend it. And then over time, it holds its value, but most likely it goes up in value as well, slightly. So if you know that, let's say 3% accumulation, 3% productivity growth per year is what we'd have. So if you have 3% productivity growth, then you'll double your money in about 25 years. Because the rule of 70, 20, 25 years or so, you'll be able to double your money. So if you start saving when you're born, you get gifts when you're born, your family give you some money. By the time you're 20 or 25, the say the 100 Satoshis that they gave you when you were born would be worth twice as much. So you can buy twice the things that you could buy. So in that kind of world, I think everybody would be saving and everybody would be very excited about the possibility of saving. So your parents will be very happy whenever you get a Satoshi because they think, wow, that's going to be, by the time he wants to spend it, that's going to be likely double the value that we have now. And then you'll start mowing lawns and selling lemonade at age 7, 8 or something like that. And you keep stacking. And then you get to work 17, 18, you work as much as you can, you save as much as you can. And I think it's entirely conceivable that in that kind of world, by the age of 25, you've saved up to buy a whole house in cash without having to be some kind of extra successful person. You don't have to be the king of the world, the finance person or a rock star or an athlete in order to be able to afford your own house at 25, because houses will be getting cheaper over time because it's easier and cheap. Technology improves, so we make houses cheaper. And then because people like to save, so this becomes more and more available. So the fact that it is, the fact that saving becomes a way of meeting your financial goals without having to overcomplicate things, I think is going to make savings extremely popular. And most people are going to just accumulate a lot of savings. So then you would think, well, if it's going up at 2-3% per year, why would anybody invest? And I think that would be wrong. Because first of all, this is an impossible scenario, because the only reason that it would be going up 2-3% per year is precisely because people are investing. Somebody has to delay gratification, take their savings, invest them in capital goods in order to build houses and sell the houses. And that is what produces more houses. So you're going to have to invest the capital in order for there to be an increase in productivity and an increase in production. So therefore, in this kind of world, it's impossible to say that we'd have a situation in which nobody invests because everybody gets the 3%. If nobody invests, we don't get the 3%. So that on its own, and that's marginal analysis. You have to think in terms of analysis at the margin. So you see, at the margins, people are going to seek investments because if they don't, then they don't make any returns, and their money doesn't appreciate. So people are still going to want to invest just because it's going to be better than just holding money. Most likely, if you invest successfully, you're going to be able to get a real nominal return, which in that case is going to mean an even higher real return than you would get if you're just holding money. So I think what happens is that after a certain point, once you've accumulated enough savings, then you start investing. So maybe I could imagine that in this kind of world, you keep working until you can save up for your own home. And maybe that happens around the age of 24, 26, something like that. Now you can afford your own house. You move out of your parents' house. You buy your own house. Likely that's the time at which you get married. And then you start saving again. Now you don't have to pay a mortgage. You don't have to save for a house. You start building a cash balance. And likely at around 25, your productivity is much higher. So now you can save a lot more. And as you save more, you accumulate more and more money. So then at age 30, you buy a bigger house. You got a bigger family. You buy a bigger house. You buy a nice car, probably a flying car at that point, supersonic Mach 4, middle class clunker that crosses the Atlantic in 3 hours. And then you keep saving. But then at a certain point, I mean, if you've accumulated 5 years of savings, well, 5 years income, 5 years expenditures of savings. So you have your own house, you have your own car. The house is likely very high quality because we live in a hard money world in which people invest in good quality stuff. So it doesn't require a lot of maintenance, and it's not something that you're likely gonna want to change in a couple of years. It's not a it's not a new it's not a culture where people are just always looking for things that are new. So you're likely just satisfied with your house and satisfied with your car. So you start accumulating more and more. And now you've got 5, maybe 10 years expenditures in savings. So yeah, you can spend, you can choose to start spending that money. But most likely, you live in a society in which there's hard money, so you have a low time preference, and you think further ahead into the future, and at some point you want to take a little bit of a risk to see if you can really make a real difference in your financial well-being. So rather than just accumulating 10 or 20% of your income in savings and that money appreciating at 2-3%, you start being able to be audacious with your money. So you start thinking of things like, maybe I should start this new business that I have. Maybe I should start the startup that's going to allow me to make more money than I make in my job.
The Bitcoin Standard podcast is brought to you by thesafehouse.com, my independent publisher and bookshop, selling the best Bitcoin books in high-quality cloth hardcovers built to last for generations. Most books these days are pretty fiat. They're flimsy and they fall apart quickly, and I did not want that for my books, so I set up the Safe House especially to provide you with beautiful, long-lasting classic cloth hardcovers you can proudly pass down for generations. You can get copies of my 3 books, the Bitcoin Standard, the Fiat Standard, and Principles of Economics, and you can also get copies of Lynn Alden's Broken Money, Parker Lewis's Gradually Then Suddenly, and Matthew Lysiak's Fiat Food, to which I contributed a few chapters. We now offer bulk discounts so you can buy books for yourself and for the friends and family you'd like to learn about Bitcoin. Buy any 2 books for $50, any 5 books or more for $20 per book, and for more than 50 books, it's only $15 per book. Go to thesafehouse.com, the SAIF house.com, where you can get all of these books in high-quality cloth hardcovers, delivered worldwide, and get 10% off for paying with Bitcoin. The Bitcoin Standard podcast is brought to you by the Daylight Computer. I love to work early in the morning and late at night, or in the sun outdoors, but regular computer screens are terrible at these times, and they strain your eyes. For years, I've wanted a paper-like electronic screen on a simple computer I could use to write. I tried several models, but none were very good. Now, finally, Daylight have delivered a fantastic full-function tablet with a paper-like screen that's easy on your eyes and great for outdoor use. I've been using the Daylight Computer to write my next book, and it is absolutely fantastic, and it has led me to invest in this company myself. Check out my interview with Anjan Kata in episode 249.
So I think in this kind of world, we're still going to see a lot of investment, because investment comes as a product of savings. First we save, and then when the savings grow, the more we have savings, the more likely we are to invest. So first, the money that we get, the first thing that we do with the money that we get is we spend it on essential consumption, right? So if you have zero money and you work and you make some money, obviously you're going to take that money and spend it. The first amount of money that you get, you're going to spend it on food, on the essentials. But then once you've secured all of those things, then you start accumulating savings. And then once you've secured enough savings, then you move to taking risks and getting into investments. And the more savings you have, and the more your savings appreciate over time, then the more investments you're going to be making, is how I see it. Now, in this kind of world, I think one difference would be probably, and I think looking at the 19th century, I think, the average company's size was a lot smaller than it was now. And I think this is likely to be a case of a world like this, that rather than having the same 4 giant chains of restaurants in every city, which might seem like it is more efficient, clearly there are economies of scale involved in McDonald's and Burger King that make this an attractive business model. But I think there's a lot of economies of scale involved in the capital aspect of the business, wherein if you're a large business that has 10,000 restaurants or 10,000 franchise restaurants around the world, it's a lot easier for you to find financing, and you get the financing at a lower rate. So if I'm considering the choice between opening up my own restaurant with my wife, setting up a mom and pop shop where we just produce the food that we like, the way that we like it, and with our own vision of what this restaurant is, and we try and borrow, and that's in today's world, we'd like to have to borrow at 10-12% or something like that. Whereas if we join into McDonald's, then we are getting into if we just work for McDonald's, or if we just manage a franchise for McDonald's, then we are being part of a business operation that can borrow at 3 or 4%. So this for me is the main advantage, more than the brand names, more than the marketing, probably. I mean, I could be wrong, and it's very difficult to tell, but I suspect it's a big chunk of the advantage that McDonald's has over the mom and pop shops. It's the cost of capital. McDonald's can get a lot lower cost of capital because of size. Because for me, if I'm just one restaurant, mom and pop shop in a small town, well, something bad happens in the town, my restaurant is ruined. So this is an enormous risk that you are taking as a creditor when you're lending to me. Whereas if you're lending to McDonald's and my business is just one of 10,000 McDonald's franchise restaurants around the world, then something bad happens in my town, McDonald's is going to be all right. And since I'm not the one taking the risk, mostly, since the capital likely is, a big part of it is borrowed by the major company, then it's maybe safer for me. So because of that, I think size would likely be smaller in a world in which everybody had their own saving. Because why would you want to? I mean, obviously there are reasons why you would want to be part of McDonald's. It's a big brand. They have their advertisements all over the world, so there are advantages to it. But I think at the margin, there will be more incentive for the average person who wants to start a restaurant to make their own unique individual restaurant rather than get into a large cookie cutter franchise system. So I would imagine that there would be a lot more smaller businesses. So this is one way to approach this question. If we have smaller businesses, then that doesn't mean obviously there won't be bigger businesses, but I wonder how much we're going to be having something like a giant stock market index investing, all these massive companies. I wonder how much there would be an incentive to IPO, for instance, because right now, and I think looking at what's been going on with Michael Saylor and the things that are happening with their ability to raise capital, I mean, it really clarifies just how much of an advantage there is to being a publicly listed company in terms of your ability to mobilize capital. That's why Michael Saylor has been able to borrow, what is it, 10, 20 billion dollars at this point. Who knows, who can keep count even. He can borrow all of that at a very low cost. It's very difficult for you and me to be able to get that because we don't have a publicly listed company. So I think part of the incentives that are politically placed in order to encourage entrepreneurship and listing on the stock markets make it so that there's an incentive to get bigger, get listed on the stock market, to IPO. And you can see how this is, you can also see why this is the case, because there's a lot of fraud of people trying to get into IPOs in a way that's improper, because there's a huge advantage to it. If you list on the stock market, a lot more people are going to invest in your company than if you're not listed on the stock market. And the reason for that is that there's a lot of people who need to invest, even though they don't understand what they're investing in, because the alternative is their money is held in fiat, and so it's a melting ice cube. So you get rid of that incentive. If your money isn't melting, then there isn't that enormous amount of capital that's just looking for anything to invest in, trying to find any kind of buzzword to chase. Then I'm not so sure that there's that much of an advantage to IPOing versus using your own savings, or at least using private equity, venture capital, rather than public markets. I think that would undermine the incentive for getting into the large public market. So that would likely mean, I think you could make a case that we wouldn't really have the S&P 500 be as important as it is today, right? So it wouldn't be the case that everybody just, and right now, the S&P 500 is effectively money for many people, in that under a gold standard or the Bitcoin standard, you earn your money and you just keep it in that money, and that's how you hold it. That's your savings. And now for a lot of people, the The equivalent is you earn your money and then you spend the stuff that you need to spend, and then all the savings you just put them in the you put them in the S&P 500, you put them in Nasdaq, you put them in index funds, and that's the default. That's what is the default for many people in terms of what they do with their money, and that's because this is just the most reliable way, I think, of beating or maybe at least staying even with inflation. So if you do it this way, then, or if you think of it in that sense, then I think this question wouldn't be as, this question isn't quite as applicable in that situation as it is right now. In other words, people aren't going to be thinking in terms of what's the S&P 500 doing compared to money, because the S&P 500 or whatever equivalent of it is not such a big deal, because there's not as much money chasing this kind of relatively very attractive option for investment, because these are all companies that have been audited, regulated, supervised, they're listed on the market. So you know that if a company in the S&P 500, you have a higher degree of certainty that it is well run. It's a lot easier to just trust all of the market processes that went into selecting whether that company can go into the S&P 500. So, you go through all of the regulatory stuff to make sure that you can list on the stock market, and then you get into one of these indexes only if you perform really well over a certain period of time. So obviously this isn't ironclad. There are a lot of fraudulent companies, maybe not a lot, but there are fraudulent companies that make it into these big things. But on average, $1 in an S&P 500 company is likely to outperform $1 outside it. Actually, I'm not even sure about that. Probably it's true. I haven't seen empirical research on it, on the performance of the S&P versus other stocks, but I'd imagine it's likely higher, because to get into the S&P, usually, you've gone through a growth spurt in order to make it into the S&P, and so likely that carries on for a few more years. So the S&P 500 is basically doing the hard part of picking the winners for you. So likely it outperforms the others, but I'm not sure. But in any case, so take away the fact that money is devaluing, and so there isn't that enormous sum of money that's out there looking for accumulating, looking for passive investment effectively. And then you take out the incentive to list these companies, and you end up with the S&P being something significantly smaller, perhaps, in terms of real size. And you end up with a lot more of a diverse and varied ecosystem of many, many, many small companies. And so with that, it becomes more difficult to think of, to try and aggregate all of the returns of all of these companies into an index, because you have to weigh them. And then, there's, and it's a much larger world of companies out there. A lot of them are not listed. A lot of them are not public. And so you can't really tell how they're performing. So it might just not even be easy to answer a question like this. So yeah, maybe there is something like the S&P 500, but if it's, say, a fifth as large as it is right now, then it's not, relative to the size of the economy and relative to the size of cash balances, then it's not very clear to me how important that metric is. And then if you try to expand it to include all the other companies, then it's also not clear to me how you'd calculate that. So all these make this a very difficult question to answer. But even assuming that we did have some kind of equivalent of the S&P, if we did have some kind of equivalent of the S&P in terms of, sorry, one sec. Even if we did have some kind of equivalent of the S&P in terms of just being able to measure the average performance of, um, say, the biggest companies, or maybe the say 1,000 or 5,000 biggest companies or something like that, then we really get to the meat of your question, which is how is that going to perform next to just holding money? And it's a tough one. One way to think of it is it's going to outperform holding money because all of these are productive companies. And so they are adding value. And so they're making positive cash flow. And if you have a share in that company, you're going to be making a positive cash flow. So maybe in this situation, the aggregate return on all of these companies be at the month. There's a part of me that wants to think it's going to have to add up to zero. It's going to have to add up to basically, it's a zero-sum game since we have a fixed sum of money. And so we only have the same amount of coins out there. So if your company is making a profit, then my company is losing money. And so on average, if you add up all of the investments add up to zero. There's a part of me that wants to say that that is the answer, but I don't think that's correct. I think there will be companies that lose money, but I think over time, entrepreneurship rewards people who make good choices and punishes people who make bad choices. And so you're likely to end up with more money in the hands of people that are making good choices rather than in the hands of people that are making bad choices. And so therefore, the capital that is deployed in economic production is in the hands of people who tend to make better choices, and therefore it's going to have a positive return. And one thing that makes me suspect that this is likely to be the case is that precisely because the money is good and the money appreciates, all the people who aren't really, really, really good at allocating capital, all the people who really don't have an extremely very good idea about how they're going to deploy their capital are just not going to do it. And the people that are going to do it are the ones who have a very good idea about how to do it. So currently, everybody needs to try and have an opinion about what Facebook or Apple or Google or Netflix or NVIDIA is going to be doing. And so you've got dentists and doctors and athletes and OnlyFans models that are out there trying to make their decisions on where to allocate capital between Facebook and Google and Apple and shitcoins and all kinds of crazy things. So you're getting a lot of capital being accumulated by people who aren't really qualified to be out there accumulating and allocating. I'm sorry, they're qualified to be accumulating. Everybody can accumulate, but they're not qualified to be allocating. And they may be qualified in a particular context. So as a doctor, you have no business going and figuring out the bullish case for Apple versus Facebook versus Ericsson versus Cisco versus IBM. That's not your business. But as a doctor, you get to a point in your job, say, go back to that example of the 25-year-old, you bought your house at 25, and then at 35, you've been working as a doctor for 10 years, and now you really know the business, and you really think what you're
The Bitcoin Standard podcast is brought to you by CoinKite. CoinKite are my favorite makers of Bitcoin hardware. They produce the legendary Open Dime, the first Bitcoin bearer asset, as well as the reliable Cold Card hardware wallet, the excellent stainless steel seed plates for storing your seed phrases, and the block clock. Now, CoinKite have produced the Sats card, a card the size of a credit card which can store Bitcoin and works great as a gift. CoinKite have just produced a limited edition gorgeous Bitcoin Standard Sats card, which carries the Bitcoin Standard logo, and you can get it from coinkite.shop/Bitcoin Standard. Use the code Bitcoin Standard to get 5% off your purchase. This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently.